Today we are presenting the Procter & Gamble case in Weir Group 19. So Procter & Gamble is a global consumer goods company headquartered in Cincinnati, Ohio, and it is one of the world's largest and most recognizable companies in the industry. P&G specializes in a wide range of products, including household cleaning agents, personal care items, and baby care essentials. With a legacy spanning over a century, P&G has secured its position as a market leader across various product categories, operating in numerous countries around the globe. The principal participants in the business scandal are P&G and Bankers Trust. From here, Emmy will lead us to debrief the details of the scandal.
Scandal arose from the significant financial loss incurred by P&G due to the leverage interest rate swaps they entered into with Bankers Trust. P&G lost $17 million after the Federal Reserve unexpectedly raised the interest rate. And there are three main reasons that triggered the scandal. The first one is that Bankers Trust designed a much more complex leverage interest rate swap than the previous ones it provided to P&G, and P&G did not fully understand the financial instrument and fully relied on Bankers Trust because of their steady and successful working relationship over the years. The second reason is that P&G argued Bankers Trust provided false assurance regarding protection on significant flaws when the interest rate rises through misleading and manipulation on the risks associated with the swaps. And the third reason is that the unexpected market change, the unexpected rise in the interest rate directly resulted in the significant loss in P&G. And next, patient will introduce the use of derivative securities by P&G.
So P&G wanted to lower their cost of debt financing. Their main objective was to reduce debt financing costs to 40 basis points below the already prevailing 30-day average commercial paper rate of 3.25. So they used leverage interest rate swaps. They entered into the deal with Banker Trust to use the swaps, exchanging fixed rate debt for a floating rate short-term debt to reduce interest expense. The swap had a term of 5 years and a notional amount of $200 million. For the first 6 months, P&G received a fixed interest rate of 5.3% and paid a floating interest rate based on the 30-day average paper rate minus the 75 basis points. For the remaining 4.5 years, the rate would be set based on a very complex formula that included a spread related to the difference between the yield on the 5-year Treasury bond and the price of the 30-year Treasury bond. And with Banker Trust, these are all based on the belief that short-term interest rate will remain stable or continue to decline, and they wanted to take advantage of that. However, with larger benefits, we get higher risks. So the question is, why is the mismatched formula they use have more risk than the differentials in yields? Differential in yields is more straightforward calculations. It's less risky because it's less sensitive to small changes in interest rates, making them more predictable and stable. The actual formula they use was more complex calculations and is very sensitive to changes, which add the risk and uncertainty. With that being said, using the complex formula, the best circumstance is for the spread to be zero. Otherwise, the rate would rise in a significant amount, as well as with the power of leverage so strong, it can increase the debt. Right after there's an increase in the interest rate, P&G renegotiated term of the swaps. They pushed back the date from May the 4th to May 19th, and the basis point was improved to 88. However, pushing back increases uncertainty for the remaining 4.5 years. Then Emmy will elaborate more about swaps with a break-even analysis.
Use this break-even analysis to see if P&G really understand the leverage interest swap they enter with Bankers Trust. We estimated that the 5-year CMT yield resulted in the break-even swap spread of 0 basis points and a break-even equivalent of $0 million based on the linear interpolation by using the 2 data points above and below the break-even points. We found that the 5-year interest rate would be 5.57% to have the spread turn positive and be 5.59% when the spread would completely offset the 75 basis points subtracted from the average 30-year commercial paper rates. From this analysis, we can see even though the formula that Bankers Trust designed for the leverage interest swap seems super complicated, P&G has an easy approach to find out the actual interest cost. And next, you will introduce the eventual outcome and amount loss.
The eventual outcomes of PMG is the following. On April 13, 1994, PMG announced a one-time pre-tax charge of $152 million against net income as a result of the early closing of the leveraged interest rate swaps. The company incurred a substantial financial loss due to swaps. And on October 27, 1994, PMG filed a lawsuit against Bankers Trust. This lawsuit finally allowed PMG to pay a much reduced amount of $35 million. So the question is raised that should Judge Fakens have ruled in favor of PMG on the issue of fiduciary responsibility? We think that the answer should be partially yes, because PMG and Bankers Trust should both be responsible for the failure. For PMG, its close relationship with Bankers Trust resulted in a steadily lower cost of financing than normal market conditions would have warranted. However, it was not the first time for PMG to use derivatives since, as its 1993 annual report disclosed, derivatives positions in excess of $2 billion. Therefore, PMG was supposed to notice potential risk and illegal possibilities regardless of the close relationship with Bankers Trust, but it failed to do so. And for Bankers Trust, it falsely assured that PMG would be protected against significant losses from rising interest rates. When rates did rise, Bankers Trust changed the rules, imposing on PMG a lock-in interest rate. Until the day, Bankers Trust still does not share this complicated pricing models with PMG, and PMG should not be responsible for this intentional concealment.
So how could PNG hedge its exposure to the interest rate risk embedded in the leverage swap? To hedge its exposure, PNG could consider using exchange-traded options on treasuries or other derivatives that would offset the risk associated with the leverage swap. The cost of such a hedge would depend on various market conditions and the specific instrument used. Initially, the cost of hedge might be higher than the 75 basis points subsidy provided by Bankers Trust, as PNG would be paying for the protection against adverse interest rate movements. However, if interest rates started to rise, the cost of the hedge will likely to increase and potentially surpassing the 75 basis point subsidy. This is because the risk associated with the leverage swap would become more pronounced in a rising interest rate environment, making hedging more expensive.
PNG's treasury operations were characterized as a cost center, which focused on minimizing the cost of capital through hedging and financing strategies. If PNG were to choose a profit center, it would imply that the treasury's activities are now expected to generate revenue and profits for the company. And to avoid similar debacle, the charter should include, firstly, clear risk management policies, which outline the types of financial instruments that can be used, acceptable levels of risk exposure, and mechanisms for monitoring and mitigating risks. Secondly, the accountability and oversight, which defines the roles and responsibilities within the treasury function, as well as mechanisms for oversight. And lastly, leverage reporting and control measure that include provisions for monitoring and reporting leverage associated with financial transactions, providing a reality check.
So there are 3 lessons could be learned from this case. So first, it is crucial for companies to secure financing at the least possible cost, which spans from the short-term supply funding like account payables to medium and longer-term bank loans or capital market debt. Also, stress testing and multiple scenario analysis could also be used to test potential risk. And at the same time, financial institutions must act in the best interest of their clients. They should avoid conflicts of interest and maintain transparency. Additionally, clients should be aware of their own responsibilities in financial dealings and seek to fully understand the transactions they are entering into. While boards are not involved in the day-to-day operations of the company, they must understand and be closely involved in major strategic changes. Effective communication is always the key to ensure that all parties comprehend the details of the deal. And that will conclude our presentation today.